Welcome to a special bonus edition of Main Street Meets Wall Street podcast. I'm Sturdivant Sr. Today, we're going under the hood of the global economy to deconstruct some of the most important, powerful metrics in finance: CPI, PPI, and PCE. While the headlines focus on whether prices are up or down in any given month, the real story is how these numbers interact to dictate Federal Reserve policy, move interest rates, and ultimately determine the purchasing power of your dollar. This is a deep dive session designed to give you the Wall Street smarts to understand the data before it hits your Main Street reality. Most people only react to inflation when it shows up on the grocery receipt, but by then, the damage is already done. In this episode, we're breaking down the inflation pipeline. We'll look at the Producer Price Index, PPI, as an early warning indication system, the Consumer Price Index, CPI, as your out-of-pocket reality, and the PCE, Personal Consumption Expenditures, which is the Fed's preferred gauge for making those critical interest rate decisions. If you've ever wondered why the Fed seems to move slow, or why your cost of living feels higher than the government reports, this breakdown explains the gap. By the end of this, you'll understand how these three Ps form the roadmap for the Fed's dual mandate of price stability and maximum employment. We're moving past, I think, and I feel, to look at the objective mechanics of the economy. Whether you're managing a portfolio or you're trying to protect your family's budget, understanding this spread is your greatest competitive advantage. Let's get into the breakdown.
Think about when you went shopping last week, or think about when the kids need something, or think about things that you did last year that you didn't do this year, or just pull out those bills from last year and look at where they are this year. When your utility bills come in, I usually get a chance to see like how much you spent last year on gas versus how much you spent on gas this year. And it'll show you how much you use, how much the unit price is. You'll just see that things are getting more expensive, right? And then you can go look at your paycheck or whatever it is that you earn wages from, and you can see if those actually outpace inflation or outpace your costs. Chances are they're not, and that's why Main Street is feeling the pinch. On the other side, now most people hear the word inflation, they think, one number, but Main Street, like I said, lives on CPI, Fed lives on PCE, so it's just like, what in the world? The CPI, the Consumer Price Index, once again, this is your out-of-pocket reality. The biggest chunk of it, like I said, is shelter. And even though it's seen as a lagging, rents, still up 3% year over year. Medical care, hospital services are up over 6%. This is a real big hit to the average family. And you can't ignore the gasoline prices. You felt it at the pump. You've seen it on your grocery receipts. And you definitely felt it if you tried to book a flight last month. Headlines say inflation is cooling, but your bank account says otherwise. While the experts are debating whether the economy is in a soft or hard landing, Main Street's just trying to keep its head above water as gasoline prices have surged 19 to 20% in a single month. Why is there such a massive gap between the government reporting and what we're actually spending? Today, we're pulling back the curtain on the big three: PPI, CPI, and the Fed's secret favorite, the PCE. We're going to break down why the cost of car insurance is skyrocketing, why hospital bills are jumping 6%, and why the latest sticky inflation debate means for your mortgage, your savings, and your retirement. But here's the real reason you need to stay until the end. Federal Reserve just shifted the goalposts. For months, they promised rate cuts were coming, but the latest data has set them back to the drawing board. We're going to look into it and see what's terrifying the Fed right now. Is it a metric inside of financial service inflation? Is it currently running at nearly 10%? If this number doesn't move, your higher for longer interest rate reality is not going anywhere. So if you want to learn a little bit from Main Street to Wall Street, let's go. We'll start with CPE, or Consumer Price Index. What the average urban household pays out of pocket. Shelter makes up about 35%, so it's the biggest slice. This includes, rents and owner equivalent rents, what owners would pay to rent their own home. It's currently above 3% year over year. Food, broken down into food at home, so groceries, food away from home, restaurants, going out to eat, non-alcoholic beverages. And this is currently up, 4 to 5%. Energy, this is the most volatile of it all. March saw a massive, nearly 19% spike in gasoline and over 40% jump in fuel for oil. Clearly, this is tied back to the Iran war that we have going on right now. And then transportation services, which also ties into energy. But this includes airline fares, which surged nearly 15% recently, and vehicle insurance and maintenance, the cost to operate vehicles. And then medical care, costs for physicians, hospitals, and prescription drugs. Hospital services are currently a high inflation area. Anyone who has aged knows that going to the doctor hasn't gotten any cheaper. Then we have PPI, producer price index. This is what businesses receive for their goods and services. This is a leading indicator. Final demand goods, prices for physical products sold to consumers or for exports like processed foods and fuel. Final demand services. So this includes, trade margins, wholesale retail markups, and transportation warehouse of goods. Intermediate demand, so process, this is items like lumber, steel, or chemicals that businesses buy to make their products. So the inputs, well, I guess intermediate demand, unprocessed also are inputs, but raw materials like crude oil, coal, and raw grains, so kind of things that make them go. These are usually some of the earliest warning signs of inflation. Construction prices received. So construction, that's the prices received by contractors for the buildings of new homes or renovations. These are going to be some of the earlier signs that can point to inflation or inflationary problems in our world, in our economy. When you look at if the people who are selling these items to us are paying more, chances are they're not going to eat all of those prices. Another example, I guess, depending on where you're looking at from, would be tariffs. Could be something that is included inside the producer price index. And then we have personal consumption expenditures. This is what the Fed, or PCE, this is the Fed's preferred gauge. It includes items paid for on your behalf like Medicare, employer health plans, housing and utilities, that's about 18%. Similar to CPI, but weighted differently. It accounts for like what you're actually consuming in your house. It accounts for it in a different way, whether you're buying chicken or beef or if you're subbing it out. Healthcare, so this is about 17%, and this has grown. This is much larger in PCE than CPI because it includes payments that you made to your insurance and the government, not just your copay. Financial services and insurance, costs for managing your money, bank fees, and insurance premiums. Currently seeing a growth of about 10% year over year. Durable goods, so you got to think about lasting items like your car, used car prices and new car prices are up in February. Household appliances, these are durable goods. Non-durable goods, items used quickly, clothing, gasoline, and food for off-premises consumptions, groceries. Let's dive a little bit deeper, right? So CPI versus PCE, like I said before. So this CPI basket, shelter, that's the big part, 35%. And the recent spike in medical, that's really made up a big hit in the CPI that we just saw. PCE, so the difference, the Fed is actually taking into account, like I said before, your insurance costs that you're paying into it, and it takes into more detail into your grocery bills. They're definitely way different. Gasoline has more than 7% in CPI right now in the moves, and rent also has a big part into it as well. So shelter costs, I should say. Inside those, then like I mentioned earlier, we have the early warning system of PPI, or producer price index. So this is the pipeline. This determines intermediate demand. So like I mentioned before, raw materials, crude oil, grains, things that are up for the producers, the price of bread and gas, things that flow into consumers. So another thing that you can look at as we look right now, like oil, the price of oil shot up here recently. But if you look at oil as a commodity and it's traded on futures contracts, I mentioned this a little bit in one of my last videos, actually in the last video, if you want to go back and check it out, where we actually go a little bit deeper into inflation. The data was fresh. But like I said, oil, and I was having this conversation with my stepdad the other day at lunch. He asked what I thought about oil, and I said, well, I try to take the noise out of these things, and I try to look at where the actual money's moving when I make these decisions or when I'm looking at things. And at this time, the price of oil was a little bit over $100 a barrel, but looking out the futures, if you looked out 6 months or so, they were down some. I'd seen down already in like the 60s. And these numbers have moved since we had a conversation, $60 per barrel. And that let me know that a couple things, just based on money and what people are paying. And you can't be caught off sides in the situation. So money isn't always going to show you what's going to happen in the world, because we do still have wild cards that are played into this whole situation. But what it told me was that people are paying these futures contracts, and they're either thinking that these future contracts usually stay pretty close to it. So they're thinking that the price of oil, obviously the direction is going to be lower. So they're thinking in 6 months from now, there will be some type of resolution to this situation. And then generally, the oil future prices were going down every month. When you looked at them, they were going down. They were like 90, 80. Like I said, these numbers are fluid and dynamic, and they change. One post, one tweet can make the whole situation change, just from the White House or from the Middle East. It just all depends as we sit and watch the Strait of Hormuz. But that's just an example of how PPI, the pipeline, the gas coming in, we see these things and the prices go up. We saw oil go up last month inside of the PPI report we just got the other day. And while inflation wasn't as high as it was expected to be at 1%, it came in at 0.5% in that particular area. It still was hot, right? So when you think about inflation, you have to think about the fact that inflation is added on. So when you see these numbers and they're like plus 0.3 tenths, if you had 9% inflation last year, which we didn't, so that number's arbitrary, you should think about it as from this time last year to this time this year, that price has increased 9.3. It's only 0.3. But what I'm saying is once the price goes up, it rarely goes back down. You need to see inflation prints with negative numbers in front of them for it to be going down. And then people would say, what's going on? So just things to think about with inflation, PPI. So once the PPI starts to go higher, once it's higher than CPI, are losing profits. So they're either going to raise their prices or they're going to go out of business. That's the supply and demand price, the price equilibrium. It all has to work out for you to keep your business open. Just things to think about with the PPI. It's a big thing that we just saw. So Main Street, what does that mean for you? If you start to see PPI numbers continue to go up, and I expect them to be higher next month as well, as we're still absorbing the shocks from the war. You can see elevated inflation numbers for a while here. That could point to higher prices for consumers. As I just mentioned, businesses, they're not going to eat all of these costs. Same thing happened with tariffs, but it was different with tariffs the first time. In President Trump's first administration, he enacted tariffs and the producers actually ate a lot of those tariffs. So the producers actually consumed those tariffs and consumers didn't feel a lot of it at the time. But who's to say if those didn't lay off some more once COVID went through, we had all that stimulus money, because that's when we really saw huge spike in inflation. But that's with the Fed. The Fed's plan for their soft landing, they overstimulated the economy. That's another video. Inflation. Like I was saying, so the energy and transportation spike, right? So when you see the breakdown in energy and you see airfares jump up like that, normally that would reduce travel, that would reduce spending. So if transportations or services are going down, that could, if the costs are going up, that would increase inflation. But if the volume and the amount that people are spending are going down, that's one place that they could look to save money, not on their car insurance, but you can drive less. Well, some people can drive less. I shouldn't say that so flippant, like everyone can just drive less. I know some people's jobs involve driving, which brings to, not to get too far off topic here, I had a video on the Dow Jones transportation theory, which last year and several times, it just shows that you take the Dow Jones companies that are involved in transportation, so companies like FedEx and UPS that move the products inside of the world for consumers. And if those companies are down, and they're down because when you look at their numbers, they're moving less product for people, then that is a indicator that consumers are spending less and maybe a recession or correction is coming. I guess it just depends on how far the Dow Jones transport goes down, but that's Dow Jones transport theories that you can see a real high level, that you can see from the movement of goods, whether or not the economy is strong or not. Recently, the Dow Jones transports are up. So they've come out of that recession or correction material. They did go into recession correction areas last year, for sure. But they've come back now. We see some really strong performance some of those companies. So that's just how it's all intertwined. And then that doesn't even go into, like, we're speaking about oil and gas, and that doesn't even go into how much oil and gas are actually used in products that we use every day, or natural gas, and that this whole effect is a global conflict. So PPI could be a little bit higher, which means CPI may be a little bit higher. Or if CPI is not higher, that means we can start seeing businesses shutter. So we need to get inflation under control. Service inflation, so like I said, we jump back into that. This is why the Fed was worried about service inflation. Like I said, it was up like 10%, but that's part of that is, so America, we are a service economy. We're a consumer economy, where we used to be a producing economy, where we used to be an economy that, depended on good production for most of our GDP. Now it's consumption. Or services. Like we said, people are investing in stocks that made more money, that increased their financial services costs, maybe more to manage money, or maybe more for the transactions and the underwriting for those are up. And then you have the Fed, who has set a 2% target, which they have been speaking about for years now, and they just can't seem to reach the 2% overall target. Why is the Fed stuck on a 2% target, right? If you look at GDP and what we just saw, which was revised down globally, maybe it was revised back down to like 1.6 by the World International Monetary Fund. So you look at GDP as how much people's income or wages are growing, I guess, is one way of looking at it. how much we're bringing in. So if that's like 1 or 2 or 3, hopefully you want your inflation number to be below that number. You want your inflation number, they say 2. They see its GDP is struggling to go above 2 right now, even though we had some numbers well above that last year in GDP. And we've had some before. In the long run, 2% seems to be the Fed's target for inflation because maybe they think GDP can be at 3%, 2.5, 3%, and outpace inflation. We'll see. They haven't been able to reach that 2% target yet. They haven't seen numbers in 2s yet. The last number came out with some components in the 4s, and we just see inflation is really a sticky problem. Why doesn't the Fed just cut rates right now? Well, the Fed could be cutting rates, as we've seen with the stock market going, even with Main Street feeling the pressure. If they were to cut rates, the economy is actually probably running a little bit higher than we realized, or we don't have enough data to see exactly how the economy is working or see how the economy is moving. The war throws a little bit of fog into that as far as what the economic numbers are and things in that area. So they have to kind of sit here and stay still just to see what's coming. Because if they cut when the economy's running hot, that would just drive inflation higher, right? Trying to get to that target. And because money will be overflowing, think back to COVID and COVID relief. How many people had excess money? And some of the things that happen with it. And that's when the inflationary things happen like that. Because then you see price gouging from producers, which we saw people get sued out here where I live in Wall Street South down here in Charlotte, North Carolina. You see those type of things happening. You see prices going up. You see people spending more, probably frivolously. Who am I to tell someone how to spend their money? Well, I guess I am a financial advisor, but a financial planner. But seriously, people live to their means. So when people get raises, people tend to spend more money. If that's not something, a tendency you notice, it takes a disciplined person to stay capped at a certain amount and not expand their lifestyle to the income that they receive. So, like I'm saying, tying it back to the 2%, and this 2% numbers, it's not, I don't want to say it's a number they just picked out of the air because there's like other old theories that tie to the 2% number, but there's nothing that particularly says it has to be 2%. Maybe the real rate right now is 3%. And maybe the Fed needs to realize that inflation has been anchored somewhere around 3% for so long and the economy has been running with inflation at 3%. We're feeling it on Main Street. That's because wages haven't caught up, right? We need wages to catch up. We need this inflation to cool down. We need prices to come back down as well, right? Stuff is just too expensive. Like I said in the opening, we spend way too much money on gas and food nowadays. I heard a Fed governor speaking the other day, and she said that we've experienced 10 years of inflation or 5 years of inflation, like 1 year, just some crazy amount of inflation that actually reduce your spending power. It's just in a historical amount of time and a historical amount of reduction. And everyone's lived through it. So we're all feeling it. Well, everyone who's, been alive since 2020, we're feeling it. We're feeling the impacts and we're feeling our purchasing power go down. Just think about your house. Think about when you went shopping last week, or think about when the kids need something, or think about things that you did last year that you didn't do this year, or just pull out those bills from last year and look at where they are this year. When your utility bills come in, I usually get a chance to see like how much you spent last year on gas versus how much you spent on gas this year. And it'll show you how much you use, how much the unit price is. You'll just see that things are getting more expensive, right? And then you can go look at your paycheck or whatever it is that you earn wages from, and you can see if those actually outpace inflation or outpace your costs. Chances are they're not. And that's why Main Street is feeling the pinch. On the other side, we have Wall Street at all-time records, executives taking record bonuses, profit margins coming in extremely strong, which is another reason why the stock market's continuing to reach all-time highs right now. We said the stock market at all-time highs at the time I'm recording this. With the war going on, plenty of concerns with, I guess some of the concerns have gone under the burner with the war, but people are still concerned, like I said, about right now, we're talking about inflation. People are concerned about private credit. People are concerned about just prices. People are concerned about just our country in general. Then you have, as I mentioned earlier, people are expecting the Fed to be cutting. The Fed may actually have to raise rates. We'll see. I don't know. That's not the base case. I think the Fed, like I said, I think the Fed just stays put for a while, especially with the Fed coming into a situation where now Tom Tiller said he will not move forward on the process with nominating Kevin Warsh out of committee. So we have that going on right now. And then we also have the impact of the financial disclosures that we just had from Chairman Warsh come out. Senator Warren, who is the leading Democrat on that committee, she wasn't very happy about it. She said it has, I think, $100 million or something of undisclosed money Kevin Warsh would be the richest Fed chair in history, but something you gotta realize is that most people now are probably always going to be the richest whatever in history when they take the new position as the first one. But I think he's like excessively wealthier monetarily than anyone previously in his position. So I don't know, maybe he can pay for the Fed renovation. We'll just see. But yeah, so then we talk about why this matters, Now, most people hear the word inflation, they think, one number, but Main Street, like I said, lives on CPI. The Fed lives on PCE. So it's just like, what in the world? The CPI, the Consumer Price Index, once again, this is your out-of-pocket reality. The biggest chunk of it, like I said, is shelter. And even though it's seen as a lagging, rents, still up 3% year over year. Medical care, hospital services are up over 6%. This is a real big hit to the average family. And you can't ignore the gasoline prices last month. I actually went to a conference down in Atlanta last month, and man, the gas was ridiculous to go down there, come back. So when gas goes up, CPI screams. But then you have the Fed's favorite, the PCE. And people say, once again, why do they like PCE better? It's because it's broader, a much broader index. Healthcare makes up like over 15% of total inside the PCE. But it's not just what you pay, it's what your employer and your Medicare pays on your behalf. It looks at the financial services, the industry I'm in, which once again is running pretty hot. And then you hear the Fed say they aren't ready to cut rates because these service costs are staying sticky. So there you go. And then you have the PPI, or Producer Price Index. Once again, the wholesaler version. And, you got to just remember you got to watch intermediate unprocessed goods, the raw materials like crude oil and raw grains, early warning system. Keep an eye on it. If the producer is paying 4% more to get the goods to the shelf, you can bet your bottom dollar you'll be paying more for them in a few months. That's the pipeline. Right now, that pipeline is getting expensive again. Right? So like I mentioned before, the CPI is coming in above 3, gas is 18 to 19, hospitals 6%, financial services are 9 to 10%, and then PPI final demand all in was somewhere around 4%. All this stuff comes back and will be revised, maybe higher, maybe lower, but it's still, you got to understand that CPI is going to feel higher than PCE because CPI doesn't account for substituting. So maybe these families are buying chicken instead of beef or something that's cheaper for their trading down. That's why we still feel it more. That's how that part works. And then once again, we talk about the GDP cool down. So we saw it go down for 2.5. This is really hitting in your purchasing power. This is the engine under the hood, right? So we saw it revised in our growth numbers from 2.5 to like 2. On Wall Street, they celebrate this because they think a slower economy will finally force inflation down to that 2% target. Main Street, revised GDP should be some type of flag for us. And here's why. Because GDP represents our collective income and production. So when that slows down, the big three, PPI, CPI, and PCE, and they're still running hot, we enter a purchasing power trap. If the economy is only growing at 2%, like I said before, but your cost of living is rising at 3.3%, you're effectively getting poorer every single day. Your dollar is losing its muscle faster than the economy can build it back. And that's the Fed's biggest nightmare. Well, one of the Fed's biggest nightmare. They want a soft landing where inflation hits 2% without the GDP crashing, but if growth keeps getting revised lower while these energy and service costs stay higher, Fed's stuck. They can't cut rates to save the economy because inflation is too high, and they can't hike rates further because the GDP is already softening. You're at home. This means the higher for longer reality isn't just about interest rates. It's about tug of war, like I said, in your purchasing power. So there you have how it comes to you. And we haven't even spoken about the other side of the Fed's dual mandate, employment. If employment goes, this whole conversation is a whole different thing. You need people to have jobs. You have to have jobs for people to consume and purchase and pay bills. Like I said, we're a consumption economy now. So you have to have jobs in this world, especially in America. We're the engine that drives it. What about different components, GDP? We'll talk about 5 of them. So personal consumption, like I said, this is what our economy is. This is most of our economy. We are a consumer-driven economy. People are spending more, but getting fewer goods. Inflation, right? Real GDP goes down even further. The dollar we're spending is getting less. Private investments, this is where the PPI hits home. It's if it costs more for a business to build a building, or if they invest less in new equipment or housing, this could drag down the GDP. One offset to that for the investment is inside of the Big Beautiful Bill Act, or as some call it, the Big Ugly Bill Act, whatever. Inside that act, business owners they have accelerated depreciation so they can fully take the price of that depreciate that cost off of their tax return. But you have to have the funds to pay for it before you can take the depreciation away. Government spending, so this is how fiscal policy, like tax refunds keeps the GDP afloat, but you can't keep inflation sticky by putting more cash into the system. We see government spending, people talk about the debt, $35, $38 trillion, but then the government has the serviceable debt's probably $165 to $170 trillion. We go deep on that on this channel and on one of our podcasts with James Callahan. He goes deep. He used to work for Moody, and we just talk about the government debt and spending and how lower rates help with servicing the debt. Obviously, if we have money out there, we're paying that we service at 3%, but we end up paying it back somehow at 2%, or we're extending more credit at 2%. This will help in the long run for our government's debt that we're paying back. But it seems like with the government that every dollar we get, or they don't mind spending it. And with the war going on, we're financing the war. I think just the other day, the ask from Congress was $700 billion to keep funding the wars. Government spending doesn't seem to be slowing down. I know that was one of the big things that DOGE came in, was supposed to come in and balance the budget, but we see government spending has not slowed down. Net exports, Strait of Hormuz, energy imports gets too expensive, or they act as a tax on the GDP. They're draining the wealth out of those countries over there. We're pretty oil sufficient over here for now. Continentally, you bring us in, Canada, Mexico into it, and you bring everyone in. We're pretty energy sufficient right now. We have a lot of natural gas, but you have to move the stuff. Right now, the Strait of Hormuz is blocked. So blocked in the sense that nothing's passing through, or it's a blockade by the U.S. military. I think some other countries may have joined or said they were going to join, but Strait of Hormuz is a big thing. But everyone knows about the Strait of Hormuz, so there's no point to really dwell on that in this conversation. Another example of something that could be a tax like that would be the tariffs last year, depending on, and we should probably see some of that data now coming out soon with the tariffs and how it truly impacted. You have to get that stuff on 12, 18 months before you really see it come through. But now we have a war going on, so maybe that'll be throwing off some of the data as well. We've been dealing with cloudy data here for a while. There have been major calls and moves to revise the data. Some of the models that we use is outdated, but either way it goes, the data has been sticky, or it's been flimsy, I guess is another way of putting it, but it's been foggy. We're still in the midst of the longest partial government shutdown in history, so that doesn't help with the data as well. And then, like I said, the GDP deflator. So this is the bridge, this is inflation for the whole economy. If this gets higher than the growth rate, our standard living is really shrinking. So if inflation keeps growing and our money does not, then we're going to feel it at home. It's another reason why I'll tell someone like cash usually doesn't win out. It doesn't usually win out. Cash does not win out in the long run when it comes to inflation. Just mentioned about like the Fed governor, that your purchasing power actually goes down. So if you had that money, or in the example she was using, she said every $100 would now require $120 of purchasing power. So to get the same amount of stuff, when she was talking about the amount of inflation, I think it was 5 years, because she gave 5-year extension. So you have $100 now, but the same amount of stuff that you used to get for the $100 cost $120 this year. Costs that much now. So as long as that continues to go the wrong way, we continue to lose purchasing power. So people will sit there and say, well, I'm not losing this money to the stock market, or I'm not losing this money in this type of investment. Keeping it on your bed, you're literally losing money every time. And over the long run, different type of investments, diversification, which I have videos on that as well, they outperform cash in the long run. Even if you just have your money in something like a bond that's maybe outperforming inflation, but then you have to pay taxes, depends on the type of bond you're in. But long story short is you need GDP growth to outpace inflation or stay close to it. Because that even goes into fixed incomes with people who are like retired people who are on Social Security, where their income may be based on COLA, cost of living adjustment, which is based on, I think it's CPI. It comes out once a year. It goes up or down, or it goes up based on the amount. But like last year we saw it, I think it was 2%, 2 and some change. And we already seen inflation coming in this year above 3. People on Social Security and things tied to the COLA adjustment are already losing. Now, people look at inflation numbers in a vacuum, but you got to understand why your wallet feels lighter. You got to look at the engine. Get back to the GDP. We saw significant downward revision in growth numbers, 2.5 down to 2. here's the problem. GDP represents our collective income and production, and growth slows 2%, but your cost of living is a measure of 3.3. Still running hot, you've entered in that purchasing power trap. Think of it like a treadmill. Your income, GDP, is moving forward at 2 miles an hour. But the cost of living, inflation, is moving against you. That's hard to do. At 3.3 miles per hour. Even when you're walking forward, you're actually sliding backwards. Your dollar is losing its muscle faster than the economy can build it back. And that's one of the Fed's biggest nightmares. They want a soft landing, where inflation hits 2% without GDP crashing. But if growth keeps getting revised lower, while the energy and service costs stay sticky in the PCE, they're stuck in a corner. They can't cut rates to save the economy because inflation is too high, and they can't hike rates further because GDP is already softening. For you at home, this means the higher for longer interest rate. As I said before, it isn't just a policy. It's a tug of war for your survival. If you want to protect your purchasing power in 2026, you can't just save. You have to understand the spread between these numbers. Now let's talk about the Fed a little bit and the moves that the Fed makes. What they can do. We have Fed chair wars coming in. Like I said, we've been diving into this deep dive, and we've been talking about inflation and the Fed and all these things. But what else is it the Fed has? What other things are the Fed looking at? The Fed's looking to have a dual mandate. So on the other side of that mandate, you have unemployment. And the unemployment rate has remained around 4 to 4.5%. And you also have treasuries. That's not part of the Fed's mandate, but that's part of what the rate moves on. It's the Fed's interest rate, the overnight rate, the rate that banks pay to borrow money from the Fed. So when is the Fed going to pivot? In early 2026, people expected multiple rate cuts, but now that tone has shifted. I mean, they've been steady for several months now, and they may stay that way. They've gone from dovish to cautious, and some people see where there may only be one cut this year from the Fed. Some people see where the Fed may actually raise rates. All right, Main Street, it's not all bad. It's not bad at all. It's just the world we live in right now. This is a dynamic world where you have a lot of fluid pieces, and economics and the economy can be tricky, can be a tough thing to live and learn. That's what these conversations, these videos, just talking with Main Street is about. What can we do if everything stays higher for longer? What does it mean for the average household? Well, I mean, I guess you can go to high yield savings account, right? We can go look at high yield savings account. That's it for savers. As these interest rates continue to go higher, you will earn more money on your high yield savings account, so you can have some more money in cash. Get out of those checking accounts online they're paying you like 0.25%. If you don't believe it, go look online and see what you're getting paid for your checking account. Go find a high yield savings account. Debt management, variable credit cards, those things are very dangerous. But with the Fed on hold right now, your rate should kind of stay where it is. You should take this as an opportunity to pay down debt. Although if rates go lower, your credit card rate may go lower. And then you got to think about how sticky inflation is, how it's going to impact your traditional stocks and bonds. And like I said, why this 2% target, which maybe they pulled out of the air. No, it's from old economics. But why is it important, And when is the Fed going to shift and realize that maybe they should be at 3% for a real rate and base their policy off of that? Maybe that's the thing that Chairman Warsh will enact if he's ever confirmed as Fed governor and Fed chairman. He's been a governor before, a member of the board. Yeah, don't panic, Main Street. We see the markets running at all-time highs right now. But there's definitely will be a pullback at some point this year. Another pullback. Have we seen the lows for the year? Possibly. Yeah, we've possibly seen the lows just based on the movement of the markets, how we've hit these numbers and bounced up, and on the backside, how we hit the numbers and bounce back up. So technically, it looks like we're moving. We've got above the 200-day average. Hopefully, the bottoms are in. Hopefully, Main Street can feel some relief. Hopefully, these gas prices continue to go down. So you got to remember, gas prices go up like a spaceship. A few weeks ago, we had the astronauts go up. It goes up. But it comes down, much, much slower. Much, much slower. You almost have to pull gas prices back down like a balloon in the air. So they will come down, but there aren't any gas stations out here who just bought a futures contract that was cheaper and said, let me go cut your price of gas down $1. Keep an eye on the Fed chair and that confirmation, because different Fed chairs will play a role in your bank accounts and your savings. I always enjoy watching Fed chair. Well, maybe not enjoy, but I always watch Fed chairman speeches. So if anyone ever wants to join me for that, or if that's something y'all want to see, let me know. I stream and watch him. I listen to what he's saying. I don't want the media to tell me, I'm just going to listen to what he's saying and filter it out myself, decipher what he's saying. And yeah, if you want to hear more from me, or if you want to check out more, we have the podcast, Main Street Meets Wall Street. Have some cool people coming on their next few episodes. We're going to talk about some behavioral finance. We'll talk about these crazy markets. And then also the Wall Street South Journal, which is a newsletter I launched. It's about 1,200 subscribers right now. It's only been out a couple months. So thanks to everyone who subscribed. Anyone who shared this information, if you found some value in this conversation today, hit subscribe, hit like, share this information. And then I always have to mention, or I don't always have to mention, but I do like to mention, if you're looking for a budgeting tool, I do have an affiliate deal with Monarch Money, an online budgeting tool. There's no ads in there, no spam. It's great for couples, or it's great to share with your financial advisor so they can see it. It's a great way to get everything in one place and have a solid look at it. So I'll leave a link for that in the description. Full disclosure, if you use my link, I may be compensated, but there's a 7-day free trial or 50% off with Monarch Money budgeting app. And yeah, like I said, we'll be coming next week with more from the podcast. Fresh new episodes. I'm trying to think what we talked about this week. Go back and check out some of the stuff I've had on the podcast before, like Mr. George Hoppenfuhr. He was on Wall Street for 45 years with Invesco. Brian Boltzhalter, Adam Parker. He runs Trivariate. He's been on Wall Street for decades, as well as Mr. Stephen Davenport and Clem Millers. Clem's actually a retired trader now. He is a professor at Georgetown. We spoke about Bitcoin. Also, Mr. Stephen is an expert in options. CFA, they're both CFAs, certified financial analysts, and they're skeptics. But he's talking about options, how they can work inside your account. So there's a podcast episode on there. All this stuff's on my YouTube channel as well. And then Mr. James Callahan, like I said, where we just talk about the debt, and that might really scare someone if you want to hear some big numbers, talk about the serviceable debt that the U.S. has right now. So those are just some of the things that we've always been talking about, that we've talked about already on the podcast and down here in Main Street. Stay focused, stay invested. Hopefully this war resolves itself. Take a look at your budget when you get a chance. Sit down, see where you're actually spending money, so you know when this inflation data comes out. Remember, PPI, that's what producers are paying. So that if you see PPI continue to go up, imagine that's going to hit you soon as a consumer. CPI, Consumer Price Index. PCE, Personal Consumption Expenditure. That's inflation in a nutshell, how it kind of works with you on Main Street and at your house, how the Fed uses it to gauge their tools. So thanks for checking this out. Thanks for joining. Once again, we have the Main Street Heart meets Wall Street Smarts. We'll talk to you next time, Main Street. If you have any questions, if you want to connect, like I said, you can find me on YouTube, hit subscribe, like, check it out on LinkedIn. I'm on LinkedIn, Marcus Sturdivant Sr. And if there's anything that you want to talk about, if there are any topics you want me to cover, feel free to check it out. Right now, a big thing is the Trump baby accounts. They actually did that. I actually signed my children up for those when I filed my taxes. It's just a box you can check. But I have a video on there with like a 30-minute deep dive on Trump baby accounts, how they work. One of the big perks with those, if you do it, is if you have a baby boy from 2025 to 2028, it has $1,000 seed money put in there from the Treasury, from the taxpayers. And some other advantages, but it's not the only tool in the shed to say. So looking forward to some of the conversations coming up. Let me know if you need anything, Main Street. Let me know if you want to talk about anything, leave it in the comments, and we'll talk to you sooner than later. Main Street, Heart, Wall Street Smarts.
Now, before I go, I have to address something you'll see in the headlines. Core inflation. You'll notice the media often reports two numbers, the headline and the core. You might be wondering, why do they report a version of inflation that ignores my food and my gas? Those are the things I buy the most. Feels like a slap in the face to Main Street. But there's a technical reason for it. Fed views food and energy as noise because these prices are tied to global oil markets and weather patterns. They can swing 20% in a month and then crash the next. The Fed separates them to find the signal, the underlying inflation in things like housing, clothing, and services that don't change overnight. They want to see if the entire economy is overheating or if it's just a temporary spike at the pump. But as we discussed today, when the signals stay high for too long, that noise starts to sound a lot like a permanent problem. We didn't have time to go deep into core today, but there's a massive debate happening right now among economists. Some say core is the only number that matters for interest rates, while others argue that ignoring the price of eggs and fuel is why the Fed was so late to the game in the first place. If you want me to do a dedicated deep dive video on core inflation, and specifically how the Fed uses it to justify keeping your interest rates high even when you're struggling, drop a comment below and let me know. Remember, the headlines are for Wall Street, but the data is for Main Street. We now have the breakdown of the GDP revisions, the big three inflation metrics, and the Fed's 2026 roadmap. Use this information to protect your purchasing power and stay ahead of the curve. If this breakdown helps you make sense of the noise, do me a favor. Hit the subscribe button, give the video a thumbs up, and share it with at least one person who needs to hear the truth about where the economy is headed. I'm Sturdivant Sr. with the APC Squared. Stay focused, stay invested, and I'll see you in the next one. Wow, what an action-packed episode full of information. We covered the 3 Ps, the early warning signs of the PPI, the out-of-pocket reality of the CPI, and the PCE data that drives the Federal Reserve's hand. But this final takeaway from Main Street is this. Inflation is more than just a headline. It's a tug-of-war for your purchasing power. Understanding these metrics is the difference between simply saving money and strategically protecting your wealth. As we watch the Fed navigate their dual mandate of price stability and employment, remember that the data is the only roadmap that matters. If you found value in this deep dive, do me a favor, subscribe and share this episode with one person who's trying to make sense of this economy. For those of you who want to see the visual charts and full data breakdown we discussed today, check out some of my other videos or just rewind this one. And if you're looking for a way to track your own personal inflation rate and get your budget under one roof, check out the link for the Monarch Money. I'm Sturdivant Sr. Join us next week for our regularly weekly episode as we continue to bridge the gap between institutional analysis and your front door. Thank you for listening to this bonus episode of Main Street Meets Wall Street podcast. Stay focused, stay invested, and we'll talk to you sooner than later. Main Street Heart meets Wall Street Smarts.